everyone. This is really exciting. My name is Jake Temkin, and unless anybody's been hired in the last 24 hours, I believe I'm the first or the latest employee to join MarketX. So let me introduce our panelists and give a little brief intro. Dominic Perry is a partner at Vertex US, pioneering early stage venture capital fund. Some of the investments include Launch Darkly, Perimeter X, Very Good Security, Hasura, Tulip.co, Desktop Metal, and more. Dom held senior corporate business development and M&A roles at Dropbox, Tesla, Flashpoint, Juniper Networks, Internet Security Systems, which was later acquired by IBM, and Brack Systems, later acquired by AT&T. Jason Kong, our next panelist, he started his career in software development at WillowTree and in investment banking at Morgan Stanley, where he worked in the Global Technology Group, analyzing mergers, acquisitions, financings, and strategic alternatives for leading technology companies. With a BA and an MBA from the Wharton School, Jason has invested in top unicorns such as Dataminer, UiPath, Attentive, Brex, Harness, Slack, Discord, Figma, Niantic, and others. Welcome, Jason. Our final panelist will be Justin Manikas. Justin is the VP of Partnerships of Nomad Data, an AI-powered data sourcing startup. Prior to that, he was at Dataminer for 5 years. He has over 15 years of experience in financial services industry, product management, alternative data, and private markets. He's a graduate of Cornell University. Welcome, Justin. So today we're going to be talking about enterprise technology streamlines workflows, improves communication, and provides access to data. At its best, enterprise technology makes it easier for the entire organization to work seamlessly and achieve its goals. At its worst, it leads to employee complaints, confusion, and inefficiency. Enterprise technology refers to the concept of information technology resources and data that are shared across an enterprise. Efforts like IT strategy, portfolio management, and IT governance enable this concept to function effectively. Some examples of enterprise technology includes content management systems and customer relationship management systems. Enterprise technology companies often find that their investments in digital sales fail to achieve expected gains after a promising pilot stage. This problem is rooted in difficulties scaling the initial successes. Companies that persist in improving their digital sales execution can achieve an incredible value. Research shows that companies with the best digital capabilities generated significantly greater return to shareholders than the rest of their field and reduce their cost of service. I'm going to turn the rest over to Catherine, who will lead the session. Thank you.
Awesome. Well, thanks everyone for joining. And as always, enterprise tech is one of the most exciting areas, and we're really glad to have people from both the operating side and also the venture capital side joining us today. Speaking of which, enterprise tech is basically omnipresent in all the world that we see today. Granted, MarketX looked at fintech, we looked at next-gen transportation, and vertical SaaS is one of our key verticals. And now, with this 2021 being a very robust year for venture investing in SaaS. So I like to start the panel with asking all of you to share with us what is the most exciting thing you find in 2021. What has happened in your maybe from the way you look at investing, maybe the way you look at companies. What was the most significant moment?
Sure, I'm happy to jump in. Hey, Catherine. Hey, everyone, I'm Dom. Thank you for the kind introduction. Great to be with you with Vertex Ventures. So I think when just zoom out on the enterprise space or enterprise companies, I think there's always the need to run faster, smoother, and more securely. That hasn't really changed, and it's only accelerating. So there's unprecedented growth in the enterprise sector, and in our opinion, it's the most exciting and lucrative value creation opportunity out there. I think it also drove much of what we saw during COVID with the accelerated cloud adoption. I think enterprise really had a lot to do with that. The beauty of enterprise tech is, in the big enterprise space or the problems within enterprise, they're actually not that hard to recognize if you know where to listen. Even the best customers or buyers still take years to embrace modern technologies and digital transformation, and many laggards still have yet to catch up and embrace it. But I think, from our vantage point, we see the best of what's to come through our open dialogue with these folks, whether they're CIOs or IT buyers of enterprise companies. And it really helps us identify, the major trends and shifts. And we try to match that up with entrepreneurs that we meet at the early stage and, that we feel are best suited to solve those big problems. And that's really our investment thesis in a nutshell. Operators give us the present view, founders give us the future view. And, we often bring these folks together, and this collision usually leads to very rich insights, allowing us to, sharpen our investment thesis, if you will. The areas we're sort of paying close attention to speak directly to Catherine's question, I think is really sort of taking place in the data management space. The way enterprises work with data has not really evolved meaningfully in the last couple decades. And, yet the appetite for data agility is driving founders to build software that can provide higher level of abstractions for common data operations. So more and more users can work with that data. I think SQL continues to dominate as the lingua franca among the analyst class, resulting in a lot of tools that employ SQL as the primary interface. And I think among data engineers who are often, the people we're investing in, Python and Scala, reign supreme with Jupyter notebooks sitting at the center of much of their work. So we anticipate more innovation in those areas of data exploration, verticalized data infrastructure solutions, and visualization tools, and specialized for specific lines of business.
I'll just jump in here and follow up on what Dom was saying. I think, very similarly, starting from a macro perspective, I think 2020 into 2021 was a very challenging year, certainly from a global health perspective, but also from a just market uncertainty perspective. And I've had the benefit of sort of seeing SaaS, run in this 10 plus year bull market that ended in 2020. And there were a lot of questions as multiples changed from 2013 to 2015 to 2017 to 19 and so on and so forth. When does the music stop? And, how robust are these growth tailwinds behind enterprise SaaS? I think if anything, the COVID environment and shift to remote work showed us how much more opportunity, as Dom was mentioning, there is in B2B enterprise companies. I remember in the public markets, we were large investors in CrowdStrike and Datadog. In the private markets, they went public, and sort of at the peak of market uncertainty around COVID in March 2020, stocks were down 50%. And since that time, I think stocks are up probably 800 or 900%, just as folks realized, as the world moves increasingly digital, increasingly remote, a lot of these technologies that these companies are addressed around security, around cloud infrastructure, around automation, UiPath, a recent investment that just went public for us, those tailwinds aren't going away at all. And if anything, are only going to become more and more important for growth for companies. And so from a public markets perspective, where Dominic invests on the earlier side, IVP, we sort of do Series B and onwards, I think we see a really robust exit market. We see a lot of continued opportunity for innovation, and also just a lot of appetite from both buyers at the CIO, CTO level, as well as from the public markets perspective in terms of interest, just because there's so much growth in this category.
Great. Justin, would you like to add to that?
Yeah, I think I'd echo what both Dom and Jason said around data in particular. I think the explosion of data available both internally but also externally is something that I'm on the bleeding edge of here at Nomad Data, seeing more and more corporations realizing the value of the data they have internally, and as Dom mentioned, finding ways to analyze that, present it to more and more users internally and make decisions. That's a huge tailwind for our business. At the same time, a lot of these corporations starting to realize that they can monetize that data externally and incorporate that external data from others into their own decision-making processes. So for me, obviously, the last year and a bit working remote and seeing that here at Nomad Data is quite intriguing, and I think it's going to only continue.
Great. So let's move on to the next question. This is an exciting one. We know that valuation around enterprise SaaS has reached, unprecedented level in some ways. We see that a lot of investors have been quite nervous about this. Can you comment on what is happening right now, all the way from pre-seed to public company? What is driving this kind of valuation increase? And as an investor in the private market, how should we adjust to the changes? And, should we hold back? Should we keep investing? What are your advice?
Happy to jump in. Thanks, Catherine. So, I think, Justin mentioned tailwinds. I think you can certainly point to the record financing we saw just in the first half of this year, coupled with the massive exits, both IPOs and M&A, I think certainly have been contributing to, these valuations as well. And I think the other data point you can look at is, we're still in the early innings of cloud adoption. And, Justin was touching on this, I think I look back at, that famous Andy Jassy slide at AWS, showing cloud, their cloud computing is only 5% of a $4 trillion market. So it's fair to say there's a lot of runway still ahead of us. And I think companies are being rewarded for that when they're demonstrating the right sort of approach to solving these big problems. And I think the way it's impacted Vertex is, we've sort of dealt with the, if you want to call it frothiness, we went outside Silicon Valley and found exceptional founders in places like Canada, Germany. We have a company called Ops Level in Canada, a company called Gitpod in Germany. So I think 75% of our Fund 2 investments have actually come from outside Silicon Valley, even though our entire team is here in the San Francisco Bay Area. So that was kind of one way that we're addressing it, again, from the really early stage of seed and Series A.
And maybe just chiming in with the sort of Series B and beyond perspective, I think, yes, definitely valuations are sky high. And I think a lot of that, again, is reflected in the public markets and the private markets sort of being a laggard to where things trade in the public markets. But I think just given the inflation environment today and low rate environment, there's a lot of appetite for growth from money managers, from LPs, et cetera. And I think technology and particularly B2B SaaS continues to be the leader in terms of being able to offer growth in an environment that rate changes and consequently the risk appetite for investors change. I think we have seen, hiccups in the multiples and the valuations, certainly in the public markets. But again, I think when you look at private markets with the amount of capital that's been invested behind venture and then sort of LP entrance into the space, I think there's a lot of dollars to go around to continue fueling innovation. And so the dollars really end up flowing to the best companies, in which case, multiples that are probably 2, 3, 4 times where they were just a couple of years ago. And so what we've done, I think we've continued to pick our spots in terms of where we invest in enterprise SaaS. I think we continue to really focus on teams and we focus on large market opportunities. And I think there is a lot of discretion that we try to take on in terms of identifying the right opportunities that even at these high valuations, as things go right, have the opportunity to 5, 10, 20, 50x from here. And then I think, as Don mentioned, certainly we've gone abroad. I think particularly in Europe, over 50% of our new deal activity since COVID has been in European headquartered or based companies. And again, our team is all based in the San Francisco Bay Area, and also just other categories. We spend a lot more time in terms of social and gaming, in terms of digital health, certainly trying to find areas that might not have the same valuation environment, but are equally exciting from a potential exit prospect perspective.
Great. So the next question we have here is, it's been over a year now since the COVID pandemic has impacted our lives and work. What kind of enterprise technology companies do you see that has really changed the way we work? And also, do you see these trends continue after COVID?
Happy to kick this one off. I think we definitely saw a lot of change as a result of COVID. And I think our belief is that a lot of those changes will continue to persist even as different firms decide on their return to work strategy. I think, let me just highlight, call it 2 or 3 key trends here. One is certainly around this concept of future of work and collaboration, which I think we already saw in the lead up to COVID. We're investors in Slack. We saw it with Atlassian, with Zoom, certainly, that were really strong secular names even before COVID. But sort of as a result of the COVID pandemic and everybody not being able to be in person, and particularly knowledge workers having to work from home, I think we saw the tremendous rise in the power of remote technologies for collaboration and communication. So in that time, we've invested in Figma. We invested in a company, Hopin, which actually does virtual events and was the fastest growing companies in 2020. And I think there's certainly a lot of other startups that have gone really 0 to 100 over the past year behind that. Will they face some headwind and growth in 2021 to 22? Quite possibly. But at the same time, I think, compared to a pre-COVID period, I think there's, we see so many more startups today that are starting fully remote. We see, large businesses, the likes of Twitter and Square, that are going fully remote. And so I think that's a trend that's here to stay. And then the second piece is probably something that enables those types of companies. Again, we see a lot of infrastructure for remote work. This is certainly on the IT and cloud level. But then also something like HR and payroll. We're invested in a company, Papaya Global, based in Israel, which helps companies onboard remote workers. And remote.com and Deal are two other ones in the market. And all of these have sort of really quickly accelerated to unicorn level valuations because, again, there's an opportunity to address this increasingly remote workforce, talent from all over the world, certainly Europe, India, Asia, et cetera. And I think that's this globalization of the knowledge workforce is something that's here to stay as well.
Yeah, we have a few portfolio companies using Papaya Global. It's a great company. Yeah, I would, not much more to add other than I think COVID really was obviously a huge forcing function. It became more of a, do or die agenda instead of a nice to have. And I think that was the biggest shift from pre-COVID. And, I think fundamental business processes have changed, and early winners are being proven through that. I think the categories I see, Jason pretty much touched on all of them: remote work, process automation, virtual replacing physical. Those are the big obvious ones.
And I would just echo having, joined a company that was founded during COVID. I think to Jason's point around collaboration tools, that's absolutely a necessity and will continue to grow, but also automation, right? I think, just founding a company in the middle of COVID has pretty a bit more of a lean view on hiring, right? The uncertainty in the market and being able to automate a lot of these processes that typically would require additional resources, either in engineering or in customer support. Tools like, chatbots and ticketing platforms, things like that, I think will continue to, even after COVID, be a place where, small enterprises continue to spend, given they've seen the success they're able to have with a very minimal investment early on in COVID and the ability to scale that going forward relatively easily.
Great. And let's stay on Justin for a moment. So I know that, you started also, a couple of companies and also looking at your experience working at data miner. So when you are getting, in that world of enterprise SaaS and also some with fintech, what are the things that kind of propel the service, right? Like when you see the growth of data miner or some of the up and downs of that business, clearly, and I know Jason's also an investor, if you want to chime in, how do you see that business being propelled or impacted by the growth of, enterprise SaaS?
Absolutely. I think, data miner founded back in 2011, very different story than what we're seeing today, right? I think back then they were kind of on the bleeding edge of the incorporation of data, in their case, real-time data, into decision-making processes of large global organizations. They were founded originally with a focus on the financial services industry, but very quickly were propelled to much higher multiples, as Jason can speak to, given their exposure to the public sector as well as to corporations themselves. So I think that kind of speaks to the democratization of data and the wave they were able to ride, originally being focused solely on how do we make some money off of information that no one else knows, to how do we equip the most important decision makers in the public sector, first responders, the military protecting us, all the way through to Fortune 500 companies that have that same type of need to be able to integrate information and real-time data as quickly as possible. So I think that's one of the things by far, that wave of real-time information they were able to ride.
Yeah, I think on data miner too, I'll just chime in because IVP, I think we're the largest investor now and been invested since 2013 or 2014. I mean, I think when we just look at SaaS broadly and some of the changes in SaaS today, I think earlier it was mentioned sort of Salesforce and Workday, ServiceNow, a couple of those emerging SaaS companies are really workflow technologies that moved on-prem solutions into the cloud and allowed those workflows to occur in the cloud. Whereas today, I think, a sort of understated but really important part of B2B SaaS is this concept around artificial intelligence and the ability to take data and gain knowledge and then have the software actually provide practical value beyond just that workflow perspective. I think that's something tremendous. That's a lot of what data miner sells in terms of being able to surface the right insights and intelligence for a lot of their client base. But then I think when we look at a lot of the really successful companies today in the private plus public markets, they're offering, not just a workflow solution or not just a data solution, but sort of bridging that to impact and action in a way that's saving businesses dollars or tangibly being able to show ROI. And I think that's AI, is a big buzzword and big theme, but I think it also really underpins all of the technologies in the B2B space in one way or another.
Great. Well, next we have a question for Dom. So when it comes to, obviously you've worked in many companies. I can't even name them all, just your bio is way too long. So I'm just going to ask you, your experience working with, Dropbox type of the world. How do you see that change, in the last 10 years? And where do you think the highest growth will come from in the next few years?
So is that sort of more around like
Around business development
BD and
all
partnerships and
exactly.
things like that? Yeah, BD, certainly a big fan, and having spent a lot of my career doing BD and corp dev, and I'm sure Justin will have some opinions doing this now full time at Nomad. It's a really important and dynamic role, and I think it has a lot of range, and if done well, can really be impactful to any company. And you're seeing many great BD leaders go on to be CEOs of companies. I think Peggy, I forgot her last name, she left Microsoft. She's a CEO of Magic Leap now. Just one of many BD people that have turned into CEOs. Partnerships was a big part of what we did at Dropbox, the ecosystem of working with all the top SaaS companies and building that out for a better customer experience was really important. Monetizing it was not that easy, and I think it's something they're still figuring out. So that's kind of always the big question is, how do you actually make money from it? But I think equally as important was the end user experience was vastly improved by all these integrations and features from third parties. As the investor side of it now, usually what we tell founders is to probably consider Series B as the right time to maybe hire a BD leader or build out your partnerships. Not to say you can't do it sooner. I just think it tends to be around that time frame, and at Vertex, because we do a lot of early stage, we often help on the BD side as well. So because our backgrounds are pretty diverse of a mix of starting and scaling companies, and our fund size is really small, that really allows us more time to spend with our founders. And so we're often helping them with a lot of BD activities, go to market partnerships, making sure we're talking to all the top acquirers out there, things like that. So that's where we're spending a lot of our time.
I would echo Dom's point there. Even though my title may be VP Partnerships, that's only one of the many hats that I wear these days, given we're a seed stage company. And I think figuring out that fine line of how much time to spend cultivating those relationships and growing them, keeping them fresh while they may not be delivering any kind of monetization immediate. It's important to be out there in the space and continue those conversations, while at the same time focusing back internally on the blocking and tackling of the go-to-market and actually driving sales as well. So it's an interesting dynamic, especially coming from a much larger organization previously, Amadeus, 10,000 plus people. Spent a lot more time on the BD side, now being at a 5 to 10 person organization, having to put that hat up for a second and focus more on the blocking and tackling like I mentioned.
All right, so the next question is on the rise of solo GPs in enterprise SaaS. What is the sort of driving force, and how is that changing the competitive landscape when it comes to enterprise SaaS investing? Is it correlated to the Series A to growth stage and across PE hedge funds? I guess we'll start out with Jason.
Yeah, it's I think since call it the last 5 years, it's definitely been a lot more capital flowing into the venture capital space, but sort of commensurately a lot of disruption for folks who have been around the venture space. And IVP, we've been around since 1980, so certainly been a recipient of that disruption, both from maybe less so from the solo GP side, but certainly from the hedge fund crossover side. I mean, I think the takeaway is venture as an industry is certainly dynamic, and there's innovation here as well. I think Andreessen 10, 12 years ago really brought this operating model into venture, and that was really novel at the time and really disruptive and continues to be. And then when we looked at it, I think it's really around we're selling a product for our entrepreneurs. That product is capital and advice, and what we're buying is or what they're buying from us for that capital and advice is a share of their companies. And so I think we're continuing to try to innovate and figure out what is it that entrepreneurs need and what is the biggest value drivers for that. And so hedge funds and crossovers, I think they tell a really good story around the opportunity to follow on and build really public positions or really large positions in the public markets, the opportunity for fast capital, for really passive capital. Obviously, that's a different pitch than what traditional venture firms provide. I think I'll let Dom and Justin speak more on the solo GP side, but I think similarly, the opportunity to work with somebody who is calling the shots, who has a really great network, who you don't need, go to a really institutional type firm. I think that's really attractive both for a lot of entrepreneurs as well as for a lot of LPs. And so I think that's a trend that we're going to continue seeing moving from here.
Yep. Yeah, it makes sense, Jason. I think, the solo GP, there's a lot been written about that recently, often viewed as the evolution of super angels, where the brand of, their fund is really the individual. It's the person. And those funds can be, pretty large, 50 million and above. We see solo capitalists falling into two buckets, essentially. There's kind of the capital as a service, which is fast money, little help. And then the other one is more of a helpful operator, where you're sort of getting my experience as a seasoned operator, and or investor from the past. And so for the second one, the helpful operator one, I think that corresponds more to what we do and also what Jason described at IVP. So we're, of the mind that, building a company takes a tribe, and experienced operators can help de-risk a lot of the aspects of company building. And, at Vertex, it doesn't stop with just one person doing the deal. It's our entire team. Even though we're 6 people, you have access to all 6 of us that all come from diverse, backgrounds, and we're all here to help the founders. So our, in a nutshell, we make fewer investments, but, we have high conviction, and we can apply our, combined operator experience. So I think there is a case where you have a certain type of founder that doesn't need a lot of help. And I think solo capitalists could be a great source of, capital there, because they can invest very quickly and move very fast. And for certain founders, that might be a really good thing. So there's certainly ways where it makes sense, and we work with them.
Great. Thanks for everyone's insights. Next, we would like to understand a little bit about data, because obviously data is a huge part of enterprise SaaS. And, many of you probably look at it, how has that transformed over maybe we can start with Justin. So now with your experience at Nomad Data, what do you see are some of the trends how is data driving enterprise SaaS? And what are some of the goals and strategy for companies who want to stay competitive, leveraging data to attack this market?
Sure, absolutely. Yeah, I think if you just rewind back to the beginning of my career 15 years ago, very few enterprises were using data to drive decision making, right? I worked on the sell side, catered to hedge funds, crossover investors. They were some of the only ones early on applying, external data to their decision making process. In that case, investment decisions. And now we're just seeing an explosion across the rest of the economy, right? So whereas hedge funds and asset managers had been at that bleeding edge and had been able to take advantage of those trends, we're now seeing more of a democratization of data across the entire economy. So operators from all different spectrums are having the ability to integrate external data into their decision-making processes and make smarter decisions based off of that. At my last role with Amadeus, we saw some of the stodgiest, most old world types of corporations like tourism boards, for example, start to realize the value in using forward-looking data that we were taking to completely change the way their organization makes decisions, from a sales, from a marketing, from a strategic planning, even from a financial planning perspective. External data, forward-looking data, nowcast data, really making it that much smarter decisions internally. And now in Nomad, we're seeing that explode as well. So rather than your traditional buyers of alternative data you'd expect in the financial services world, we're starting to be overwhelmed with people in the corporate world and the consulting world looking to take external data and make smarter decisions based off that.
Jason, would you like to take on this one?
Yeah, I mean, I think from our vantage point, data is, I think, again, to give credit to Mark and Andreessen and team there, A16Z came out with this memo famously probably 10 plus years ago that software is eating the world. And in that time, we saw the rise of SaaS and all companies become software companies, as Justin described. And I think we're sort of seeing that in terms of all companies becoming data companies too. I mean, I remember the need for computer scientists, now that's turned to data scientists, the need for processes around software, and then this whole DevOps movement has sort of moved to processes around data and data ops, and then a lot of emerging innovation around that category. And so I think there's a really robust ecosystem being formed around data as a really important asset for businesses. And this concept, at least at a high level, that all businesses are becoming data businesses in part or need a competency within data. And I think the ecosystem is further benefiting from having just seen a lot of this innovation in software. So it's really, easy to do a fast follow in terms of, this is a business that was really important on the software side for delivery or for maintenance or reliability or observability or whatever that is, and then translating that same concept to data. So I think as a result, the data ecosystem overall is moving much faster. Plus the fundraising and capital environment that we're in today just gives a lot of, essentially eliminates financing risk for a lot of these startups because there's so much excitement around the terminal market opportunity that valuations are high in this space, and everybody's really excited to invest in smart folks that are working on problems in this category.
Great. And then I guess up next, several of your investments, Jason, Discord and Niantic are prominent companies in the gaming space. What's your view on the future of gaming, right? We've also seen quite a bit of, valuation jump for Epic Games type of world. What is the gaming companies trying to capitalize on based on existing trends?
Yeah. So I think, there was a time not that long ago where gaming was really not that sexy. And I think, even thinking back to 2013, 2014, again, we've always played in gaming. We've always really liked gaming. Previously, we're investors in Zynga, we're investors in Supercell. I think we really think about it as an extension of social, and now probably a more important extension of social where, Discord very much followed in the lines of Snap and Twitter. And we see, social sort of becoming gaming in terms of how this next generation likes to interact with one another. And even if it's not explicitly a game, I think these concepts around gamification are increasingly important to any type of consumer or social experience. I think within gaming, areas that get me really excited, certainly one on the infrastructure side, picks and shovels companies, Epic's Unreal Engine, Unity, the next generation of those businesses that help more and more developers create games, I think are going to be increasingly important and a continued focus of investment. I think, certainly mobile and casual is still a really exciting category. Again, Supercell and Zynga were 8+ years ago at this point, but we recently announced an investment in a company, Dream Games. That was a spin out of Peak Games in Turkey that got acquired, again, focused on casual gaming. And then I think there's a lot of sort of emerging, again, when we think about the next generation of consumer, things like crypto and NFTs. We invested in our first NFT company. There's been a lot of hype and excitement in that space, and gaming has been a low-hanging fruit use case of blockchain and NFTs. And then lastly, virtual and augmented reality. I think we've seen, the initial pieces of that and gaming just being a really easy foray of AR and VR and part of the thesis of our Niantic investment. But I think there's a lot to come there in terms of the opportunity to have truly, high engagement, augmented reality experiences as it relates to gaming. And so more and more, Roblox is a good example in terms of this virtual space, third world concept. I think that's going to, it's essentially a blending between gaming and consumer broadly. And so we really think about gaming holistically versus, the likes of Activision and EA and where gaming might have been 10+ years ago.
Great. So the next question will be, how do you see enterprise technology use in the everyday, organization's value chain? What do you see are some, trends that are happening to, basically define key metrics, et cetera?
I'll give a quick point of view. Data comes to mind again. It's been a bit of a theme on this panel. I think for supply chain use cases specifically, I think emerging cloud platforms can make it easier to collect data from internal systems, files, and from business partners, and that's basically creating a digital representation of your supply chain. So, different types of users essentially can access that information whenever they need it. So we made a seed investment in a company called Unity SCM, really early stage. One major use case is preventing production delays due to material shortages. So, a cloud platform like Unity SCM can really help manufacturers know to have enough raw materials on hand to meet the customer demand. And, we certainly saw that during COVID with, people making renovations and buying furniture, and, it was a bit of a supply chain nightmare. So hopefully a lot of those things will be corrected.
And I guess if you wanted to just come back also to Dom, it seems like, for the AI enabled SaaS, there's like non-technical people serving, data needs, et cetera. Can you just comment on like what is growing? How do people leverage AI in SaaS as well?
Yeah, machine learning as a component of enterprise software is rearranging existing software categories in favor of apps that are built around machine learning from the ground up, and that's leading to the creation of new ones. So an example is, we invested in a company called Eversort, which is essentially they've created a cloud contract management solution, and that was a pretty sleepy industry for a few decades, but because Eversort's applying AI and sort of creates this intelligence layer, they're able to extract a lot of insights from tens of thousands of contract files, whether it's in your servers or cloud, and it can live in any silo. So it's really sort of stitching all that together and empowering lawyers and procurement people to just work a lot more efficiently. So they're really automating a lot of the aspects of contract management, and then I think there's other category creation opportunities, companies like Gong and Chorus, not Vertex companies, but they're building conversational intelligence platforms that are essentially now have become table stakes for top performing sales teams. So conversational intelligence in this form didn't really exist a decade ago. And another sort of industry we're watching in particular is that of people management as well. Companies are spending 70% on human capital, and this area still represents as one of the largest data leaks in the enterprise. So I think there's a lot that AI can do there as well.
Great. And then Jason, we have a question for you. One of the startups you invested is Slack. So now it's obviously everyone knows IPO'd in June 2019. Sorry, I just jumped 10 years in the future. What was it about Slack that stood out to you from the beginning? What kind of lessons do you think founders should learn from the Slack founders?
Yeah, great question, Catherine. I think I'll try to be quick here. I think two, quick lessons. I think one is, I think Slack is probably one of the more famous companies for pivoting, pretty dramatically in their journey. Stuart was a repeat founder. He previously tried to create a game studio that ended up turning into Flickr, the photo sharing app. He tried again, this time in recent-backed game studio called TinySpec, working on this MMO essentially. And again, didn't quite work out. They couldn't find product market fit, but they had this great IRC, internet relay chat function that then became Slack. So TinySpec founded in 2009, turned into Slack in 2013. And so when we made the investment in 2014, again, this was in the current iteration of the company, but certainly one, took a lot of perseverance for him to continue the idea and pivot. And again, investors gave him that leeway to try to build something new. And Slack, I think when we saw it was just really tremendous growth. I think, on the note of really crazy SaaS multiples, I think we paid the unicorn plus valuation. I think it was probably $2 billion entry value, and the company was $2 to $3 million of run rate revenue. So again, a pretty absurd multiple, all things considered. But I think that really gets me to the second lesson from Slack, which is I think they really were the ones who ushered in this era of what we like to call product-led growth, or again, a focus on the end users for these B2B SaaS products. Or previously, you would sell to the CTO or CIO or somebody very high up top, take them out to sales dinners and convince them, hey, this is why you need to go enterprise-wide with, Workday or ServiceNow or whatever it is. And Slack really focused on, again, bottoms-up motion. Anybody could install Slack, try it, start on a team, and slowly there was a shadow, usage of Slack that then ultimately they were able to convert to enterprise-wide licenses many years after we invested. But I think today, when you look at B2B SaaS, and you look at all the companies and products where you can just go and try it, or essentially start using it without ever speaking to a salesperson. I think Slack did a lot in terms of pioneering that motion. And that was also why they were able to grow so quickly back in 2014, because it was so viral, it was collaborative, and everybody just loved using it. And so they had the best growth out of SaaS companies we had seen at the time, and they really ushered in this new era of sales that is very much used across the venture landscape today.
And to close out this panel, I would like to ask Justin your last question here. So what we see as increasing central to the development frontier technologies, how do companies responsibly manage innovation without sacrificing profitability?
That's a great question. Yeah, so I think one of the things that I've seen here at Nomad compared to back in early days of Data Miner is that it's a lot easier to build a company without having to build everything yourself these days, right? There's a proliferation of as a service platforms, Slack being a great example, right? But the idea being we don't have to necessarily ramp up engineering costs, R&D overhead very early on by taking advantage of some of these platforms that allow us to scale at our speed, right? So there are different parts of our business that are growing at different speeds, and rather than building out a team to build all of that all at once, we're able to essentially use some of these outside platforms to do that for us, and they have models that allow us to scale as well, right? So if we start picking up on the amount of marketing contacts that we need, the amount of emails we need to send, it allows us to scale quite easily without having any kind of upfront investment. And that's a big difference from back in the early data miner days, where we had to very rapidly scale our team of data scientists and engineers to attack this problem that kept growing, right? More and more real-time information that needed to be combed through and alerted off of. And I think using some of these AI and ML platforms that Dom mentioned earlier as well can help automate a lot of those tasks that previously would require a bunch of human overhead. So I think that's one way to very easily keep costs down and drive profitability much earlier on.
Great, thanks, Justin. And I think Jake has a question here.
I think he sent it to me in chat. I could read it if you'd like and quickly chime in. Yeah, I think he was asking to talk a little bit about data security among our portfolio companies and as an opportunity in the enterprise space. And I was replying to him, and what I was saying is it's a timely question. And I think, security, of course, is very horizontal to everything that we do. I hosted a CTO roundtable just last month with our global CTOs, and there was a lot of discussion around security, compliance, governance. And a couple of quick takeaways were that security is a team sport. It's essentially, you can't, even though you're adopting and embracing the cloud, you can't rely solely on your cloud provider. That's often viewed as feudal security by most security professionals. You also need to prioritize it, compliance and governance early on. You can't just wait till you're like a big startup and scaling. You need to sort of start early. And I think the other thing is to note is that we're all human, and most of the attacks result in because of some human error that occurred. So I think that's just another proof point on why you want to prioritize compliance and governance early on, at your company. And that is also why there's so many sort of a wave of startups that are emerging in the security space trying to address this evolving, constant challenge. So it's, security has been a topic throughout my 20-year career, and it's not going to stop anytime soon.
Thank you, Dom. Thanks, Justin. And Jason, this was a very lively panel discussion, and very much appreciate your insight. Enjoy the rest of your day, and thanks again.